Superb. Right. The time is 1 o'clock in the afternoon. So good afternoon, everyone. I can see a reasonable number of attendees and additional attendees joining every second, actually. Very cognizant you are not here to listen to me speak, but I'll just give you a quick 2-minute intro and a bit of housekeeping if you don't mind. In the first instance, delighted to be here with Colm Walsh, who is one of the lead managers of ICG Enterprise Trust. In terms of housekeeping, first and foremost, many of you have probably been on previous sessions, but just to remind you that if you have any questions, please use the Q&A function in the bottom right-hand corner of the WebEx screen. In terms of timing, Colm will speak for around about 25 to 30 minutes, and then we'll jump into a Q&A at the end. For those less familiar with ICG Enterprise Trust, just on a top level, they invest in private equity as an asset class, and the asset class itself has been one that's proven to be resilient and has proven to very much outperform public markets over the medium to long term. ICG itself are incredibly well placed to provide investors with access to both some of the best managers globally and indeed the best deals globally. ICG gets superior access, and Colm will, of course, go into a bit more detail around that. But I think just in terms of the portfolio itself, investors should be aware that it's a great combination of diversification and concentration. I think with that, I will hand over to Colm and we will crack on with the presentation, and I will see you all in about 30 minutes for the Q&A. Thank you.
Perfect. Thanks very much, Hugo, and hello everybody. Good afternoon. Thanks very much for taking time out of your day to listen to me, and thanks also to all the team at Kepler for organising today's event. So what I'd like to do today is spend some time discussing the merits of listed private equity more generally as an asset class, then maybe come on to some of the key attractions of ICG Enterprise and how we think we're different, a little bit differentiated, talk about our portfolio, and also our track record, most importantly, I suppose, of delivering strong risk-adjusted returns. But just to start off, and I'd just like to give you an overview of private equity more generally. And I suppose, there's a good reason why private equity has grown in recent years as an asset class. And put simply, it's all down to the performance. It's performed very well over the last decade. It's outperformed most other asset types. And more importantly, that trend is expected to continue. As you can see on this slide, we've provided an extract from BlackRock Research showing expected annual returns by asset class. And you can see that the expectation is that the market-leading returns that private equity has generated over the last decade look set to continue. And that performance has led many of the world's most sophisticated investors, so sovereign wealth funds, the world's largest pension funds, and endowments, to up their allocation to private equity. Now, that's not so easy, of course, for a private investor. It doesn't have the vast resources and the expertise of these large institutions. Private equity is a complicated asset class to administer. It's complicated legally. There's a lot of cash management requirements. It's illiquid. And, a very simple level, you would need to be especially wealthy to invest just in one fund, let alone a diversified portfolio. In most cases, the minimum ticket size for a commitment to a private equity fund is around $10 million. So that's very much out of the reach of all but the world's most sophisticated institutions or the very wealthiest individuals. So the best way, we think, and in many cases it's actually the only way for retail and high net worth investors to get access to the asset class with a low minimum investment, is through listed private equity. And as well as providing access to the asset class, you also get access to some of the world's best managers, and you get daily liquidity. So daily liquidity, even though the underlying asset class is itself relatively illiquid. Moving on to the next slide, I'd like just to, one of the things we're always being asked about is in the context of that growth, the rapid growth, whether, there's anything to be, whether that's a cause for concern. Private equity has grown materially, as you can see from this chart, 13% CAGR since 2010 in terms of AUM. And no matter what metric you pick, whether it is AUM, as we've shown, or fundraising or dry powder, broadly speaking, the industry has tripled in size in the last decade. And as I said, that sort of sounds alarming, but it's worth sort of seeing private equity in the context of the broader global equity market. And as you can see from the chart on the right, private equity AUM is a tiny proportion of total equity market capitalization. So while 6 trillion is a big number, it's a very small percentage of the total equity market. So much of the growth, if you like, in private equity's share of the global equity market is coming from companies staying private for longer, or remaining in private ownership, when perhaps in the past they might have sought a public listing. We don't really see material price pressure coming from the expansion in the private equity asset class. And actually, we see the growth very much as being a good thing. It increases the range and scope of our investment opportunities. It's also worth putting 6 trillion into context. Now, it is clearly an enormous number, but it's less than the total AUM of some large asset managers. It's less than BlackRock's total AUM. It's less than Vanguard's. It's equivalent to the current value of 3 US public companies, the 3 largest US public companies. So it's still very much a nascent asset class, and we believe that it's going to continue to grow and to continue to demonstrate very attractive characteristics for investors. So I'd like to spend now just a little bit of time just talking about how ICG Enterprise Trust addresses listed private equity. And it's worth bearing in mind, we sometimes talk about private equity investing like it's one sort of homogenous thing, but just like public equity investing, there are different styles, different approaches to types of assets that people invest in and the way they construct their portfolios. Same's true of listed PE. Some listed vehicles, highly diversified, they're almost like indices. Some are highly concentrated in individual companies or in sectors. At ICG Enterprise Trust, we have a focus strategy compared to many of our peers. And we're very much, our focus is on trying to optimize our risk-adjusted returns. I'll go on in a second to give you a little bit more detail about how we construct the portfolios. But first, in terms of where our market focus is, most importantly, due to our sort of focus on risk-adjusted returns, we exclusively invest in buyouts. And what's a buyout? Profitable, cash-generative companies that typically mature, they're typically well-established in their markets. We don't invest in venture capital or growth equity. Now, they can offer very strong returns. We've seen that in the last few years, but that can be at the cost of high volatility. For example, in venture, very high loss rates. You've also seen in recent years that a lot of the returns have been bolstered by high valuation multiples, themselves a function of very low interest rates. And that's something which we can now see beginning to unwind slightly. Secondly, we focus only on developed markets, and that's principally Western Europe and North America. These are the world's largest buyout markets. It's almost 90% of the global total. We, of course, see some interesting strategies in emerging economies. But again, when we look at the risk reward, we believe that the developed PE markets have the best ecosystems. By ecosystems, I mean things like legal systems, the best managers, the best available talent as well in the managers based in those countries. So we continue to believe that the developed markets offer that the optimal balance between risk and return. Similarly, within those developed markets, we focus on the mid-market and larger managers. Again, sometimes that seems counterintuitive to people. A lot of our peers focus on unearthing new managers or sort of more esoteric or unusual strategies. But we believe very strongly in the quality of the world's longest established, what we call top-tier managers. We've partnered with many of them over multiple funds. We know that they have deep operational expertise. We've seen it in action. We saw it in action during COVID recently. And also critically, they've got experience of managing through cycles. And again, it was that experience perhaps of managing through the GFC, even though it was a very different kind of crisis, it was very, very relevant, transferable experience to manage through COVID. And finally, the sort of last layer of filtration, and it's something you're going to hear about throughout this presentation. We assess every fund strategy, every co-investment for its defensive growth characteristics. So we're looking for companies which benefit from long-term trends which make them less sensitive to fluctuations in the economic cycle. And we'll go through some case studies in a second about what that really means, just trying to put that into context. But before we do that, it's worth noting that the active and focused investment strategy that we have is made possible largely through having a dedicated team. Now, unlike some of our peers, we don't operate the investment trust as a feeder vehicle for a broader business. This is our main business, and it very much has its own tailored approach and a dedicated team which has been selected to execute this investment strategy. Now, the team has got a very rich range of backgrounds. Personally, I used to work for a large European buyout manager, pan-European buyout manager. And I used to also, in a previous life as a chartered accountant, I used to have some of the world's largest PE managers as my clients when I worked at Deloitte. My colleague, Lisa Lee, had a very long career with GIC. It's one of the world's largest PE investors, Singapore's sovereign wealth fund. And Lily Jones was a debt investor at Ares, one of the world's largest private debt investors. Oliver, who heads up our group, was a partner at Pomona, which is one of the world's leading secondary fund investors. And he also previously worked at both Bain Consulting and Adams Street, another large private equity investor. So we come to the table with lots of different perspectives, lots of diverse backgrounds and opinions. And we think that leads to better investment decision making. But it's also worth noting here the team that you don't see on the slide, and that's the broader team at ICG, one of the world's fastest growing and largest alternative asset managers. Not only are we very lucky to have exceptionally able colleagues in finance, investor relations, who directly work on the management of ICG Enterprise Trust, but we also have a wealth of colleagues in other investment strategies. And that platform really helps our investment team, gives us really valuable insights. And I'll give you a little case study of how that works in a second, and really helps us to make better investment decisions. I'd like now just to go on to look a little bit at our portfolio construction, which I referenced earlier on, and the performance that comes from that. I'll try and keep this simple because it's the kind of thing that could take up a lot of the presentation. So in very simple terms, half of our portfolio is highly diversified. It's invested alongside some of the world's leading private equity managers in what we call primary funds. And over the last 5 years, that part of the portfolio has performed strongly, generating returns of 18%. Now, the other half is what we term our high conviction portfolio. And that's investments made alongside ICG, our manager, that's mostly in direct investments, and also alongside third-party managers in secondaries, that's funds that have already been invested, that we acquire during their life, and in co-investments. And co-investment is where we invest directly in a company alongside one of the managers in the other half of our portfolio. The critical thing here is we get to control the composition of that portfolio because we diligence the underlying assets as opposed to making a commitment up front, which is the case with the primary funds. And as you can see, not only do we have the benefit of control, but we also it also has a significant performance benefit with a 5-year annualized local currency return of 25%. But the number we really focus on is that 21%, because the two approaches are very complementary and they're intertwined. So we're very proud of a 21% return over the last 5 years, particularly given our risk-adjusted approach. And that's been achieved, we think, with very low levels of volatility. But I'd like to spend now just try and put that high conviction approach and the defensive growth concept into context just by looking at a recent investment. We recently invested £9.5 million in a company called European Camping Group. And you may be familiar as a large part of its market is British tourism with some of the brands that the group runs, like Eurocamp and Homer, Palmer's Ocean. First of all, PAI is one of our oldest manager relationships, a pan-European manager based in France. We've invested with them successfully over the last 15 years. and their investment style is very aligned with ours. They are also very focused on looking for really strong risk-adjusted opportunities. And whilst they don't use the term defensive growth, many of their investments fit our defensive growth criteria. Firstly, this is it sort of has many of the attributes that we look for. It's very much a market-leading business in its market. It's got very strong customer scores. We like the fact that PAI has very strong demonstrable experience in this sector. Those of you that have followed us for a while may remember that during the depths of the COVID crisis, we had a very strong realization of a business called Roompot, which was a very similar business operating holiday parks in the Netherlands, which PAI managed, and that was successfully sold to KKR. What was particularly impressive about that was it was sold to KKR at a very high valuation multiple, even when most of its sites were closed because of the impact of COVID lockdowns. What we really like about this specific opportunity, European Camping Group, is there's so many different ways for the business to grow. First of all, it's a really fragmented market, and there's lots of scope to grow the business just through M&A. But we also like the fact that because of PAI's prior experience, they're in a really good place to make really meaningful operational improvements to the business. And that business is going to naturally grow anyway because of the recent removal of travel restrictions throughout Europe. So as I mentioned, Britain, for example, is a very important market. Obviously, the business was very constrained over the last 2 years because of all the travel restrictions. And the outlook for this summer, record bookings, is extremely strong, driven in no small part by the removal of lots of these travel restrictions. We even saw the other day, UK government getting rid of passenger location forms. It's a very minor thing, but it helps remove a lot of the friction associated with overseas travel. This investment is also a great example of where ICG's institutional knowledge is a really significant advantage. So we have colleagues in our European sub-debt equity strategy who owned a similar business, Park Holidays, in the UK. So it was incredibly helpful to us to be able to get up the curve of understanding the business. We were really able to understand the market dynamics, some aspects around valuation, and how to assess the business in terms of its core KPIs. And the ability to have that very open and transparent discourse with colleagues, we think, is a really unique aspect of the ICG platform. I'd like now just to sort of translate that, if you like, into what that means, what that approach means in terms of our recent NAV performance. And I talked a lot about our investing style being focused on risk-adjusted returns, defensive growth, and you can see that that's reflected in the way in which our NAV grows. It's very, very consistent over the last 6 years. There have only been, 2 quarters where we've shown contractions, and one of them is fairly explicable because it was, the Q1 2020 when there was obviously significant volatility in the market because of what was then the onset of COVID-19. You can also see that our dividend has grown consistently as well. We're anticipating this year 27 pence per share, which would represent a 12.5% increase on the prior year. And overall, combination of dividends and NAV growth has generated a 17% NAV per share total return for shareholders, which again, we think represents strong performance given low levels of volatility and a very much a focus on risk-adjusted returns. I'm going to spend, I think, the rest of the presentation just taking a look at the portfolio today and giving some thoughts about how it's placed as we enter a period which is likely to be characterized by an uptick in volatility. So our efforts over the last 6 years at ICG have resulted in quite a shift in Enterprise Trust's portfolio, and particularly in geography. When we started our journey at ICG, we're a predominantly European investment vehicle, and just under half of our exposure was to the UK. Since then, we've used ICG's global network, in particular its presence in the US, to build up our US exposure. That's gone up from just under 15% back in 2016 to over 40% in the period. And we've right-sized our UK exposure, just brought it into line with where you would expect it from a normal market weighting. UK is still a really important European buyout market for us. We believe our sector exposure is also well balanced. Our approach to portfolio construction means that that high conviction approach I talked about means that much of our weightings within individual segments are to our high conviction deals. They're deals we've diligenced. So, for example, we get quite a lot of questions at the moment about technology exposure. But our technology exposure is to businesses, not many of them are household names, but it's things like IRI or Visma. They're fast-growing businesses, but they're also profitable today and they're cash generative. Their valuations aren't relying on having very low discount rates into the future. We don't invest in things like venture capital or growth equity. So this is a very different type of tech to some of the tech that's been most impacted in the public markets. We're exclusively focused on EBITDA positive, cash generative companies, and they don't rely quite so much on future earnings growth assumptions to generate their valuations. I did want to touch very briefly, you can see our top 10 assets in the portfolio. The largest one is Chewy PetSmart. That's about 6% of our portfolio value. That is larger than we would normally expect one of our companies to be in terms of percentage of NAV. But that's really just a result of an outsized performance. There is a little bit of volatility in the valuation of this exposure because quite a large proportion of it is listed. And Chewy, the listed component, has been impacted by recent market turbulence. But we think that this co-investment, there's still considerable value and growth potential. It benefits hugely from the increase in spending on pet care and pet products. And we remain really confident that it's going to become one of our most successful co-investments in our whole track record. But as I say, there's a little bit of volatility and short-term noise because of movements in the market. I'd also like, on the next slide, I'm just going to spend a little bit of time. I think this is something what we're hearing a lot from investors, just trying to understand the resilience of our portfolio. And I know that's going to be a focus for many of you. Just linking in with the defensive growth sort of theme, I think it's worth just touching on what the characteristics of a lot of these defensive growth companies are. And our active approach to portfolio construction means that most of our largest exposures, as I say, are companies that we have handpicked. So looking at businesses, a lot of our businesses are not, as I say, household names, but they often have very strong dominant positions in their markets, even if their markets aren't particularly well known. So companies like Curium or IRI, they operate in quite focused niches, but within those niches, they have a very, very strong market position. In the case of both IRI and Curium, they're broadly speaking duopolies, and they've got very strong structural, sustainable barriers to entry that protect their market position. We've also invested in a lot of businesses that provide mission critical services. So a lot of the businesses you see here, businesses like AML RightSource or Iris or Avanti, they're software businesses or tech businesses, which form a very critical part of their customers' operations, but in most cases are not a significant part of the cost base. And that gives the companies some pricing power, which we think is particularly important given the heightened risk of prolonged inflation. We also look for businesses that have good margin protection. So obviously businesses with stronger margins that acts as a buffer against volatility and allows them to absorb price increases. We're obviously not pretending that our portfolio is going to be immune from any of the external pressures that we're all facing at the moment. But we do believe that an active approach to portfolio construction and also focusing on assets that are managed by top-tier managers that have a track record of managing through these kind of cycles in the past leaves us well placed to cope with a slightly more volatile and dynamic external environment. And as we think about that resilience, another point I just wanted to make was to note that one of the strengths of private equity is to be able to grow consistently, the overall market, with lower levels of volatility than you see in the public markets. And this is a feature of the asset class, which many of the world's largest investors find particularly attractive. You can see from the charts here that the long-term trajectory of private equity is not really impacted by short-term volatility. You might see some small contractions in our NAV during periods of volatility, but it's a very different pattern to what you see in the public markets. And I think these charts also are a reminder that that one of the benefits of the private equity model is that company management teams and portfolio managers are able to focus on the underlying businesses without having to manage through much of this market noise. So when a portfolio company CEO in a private equity-backed business is likely aware of market volatility, but doesn't have to meet kind of market expectations on quarterly earnings calls, doesn't have to spend a lot of time justifying that. There's very much a long-term time horizon and an ability to be able to focus on those long-term goals and manage through it. And you can see the impact that model has had on our NAV performance over the last 10 years. And hopefully the materials we've covered give you a good sense of what we do, and I've allowed plenty of time for questions. It's very difficult, obviously, to go through all of the companies and cover all of the ground. But just to recap, we really believe in private equity as an asset class, and listed private equity gives retail shareholders access. We think that ICG Enterprises' approach is well suited to optimize risk-adjusted returns. It's a particularly retail-friendly approach. Particularly as we've just seen, it exhibits less volatility than public markets in terms of its underlying performance. Our strategy is focused. We're aiming to identify companies that have these defensive growth characteristics. We're looking for strong underlying valuation drivers, which means the companies can grow even in more challenged economic environments. We're looking to optimize risk-adjusted returns, and we do so in a way that's very selective, very disciplined. Our approach gives you access to the best in class, top-tier managers. They're typically very difficult to access, and they're selected by an experienced, dedicated team with wide-ranging, diverse professional experience to make the best investment selection decisions. And that's an approach which, most importantly, has delivered strong shareholder returns over the last 5 years. And we're very confident that the portfolio that we have today is well placed to continue to perform into the future. So have I kept my timing for a change, Hugo?
You have, Colm. That's superb, and a very compelling presentation and a strong case put forward for private equity generally, and indeed ICG. So we'll crack on with questions. I can see a few coming through, and just to the audience, as a reminder, bottom right-hand corner, there's the Q&A function. So I'll rattle through a few, if you don't mind, Colm. I've got quite a few coming in, so just thinking about where to start. So in terms of your geographic exposure, you talked a bit about increasing the US, a bit of reduction in UK and Europe, sitting where it sits. You have a small portion that's rest of the world. I've just got an investor wondering what makes that up.
Sure. So we invest in a number of funds that have a global remit. So typically, and because they tend to be market weighted, in practice, most of their investments will be to the markets we target, so Western Europe, North America. That rest of the world is a small exposure to what we term sort of the developed markets of Asia, so countries like Japan and Korea, and to some degree China. But it's not. But there's and also exposure to economies like Australia. But we have a very, very low exposure to what people would term sort of frontier markets. So even the rest of the world category, they're still arguably quite well developed private equity markets. But we don't target them because we continue to believe that the the European and North American exposure is the most attractive on a risk-adjusted basis.
Yeah, makes complete sense. Just in terms of your the relationship between the third-party fund investments and your direct high conviction investments, could you just talk a little bit around how they interact with one another? I.e., is it incredibly important to have these third-party funds to give you the access and deal flow you need?
Absolutely. So one of the problems with sometimes with when we present the slide that shows the 18% to 25% blending into the 21 is that people say, well, so why would you not just do all of the stuff that gives you the 25% return? And the reason is that you almost can't have one without the other. So our approach is fundamental to the ICG enterprise philosophy is always partnering with the best managers. And the only way to access co-investments alongside the best managers is to invest in their funds. So we invest alongside, we have about 30 active relationships of managers that we are, and most of them we aim to co-invest with. But having all of those different relationships allows us to be quite selective. So we're perhaps last year we executed about 10 co-investments, and that was from a sort of what I would call an actionable list of credible co-investments with credible managers of about 50. So having that large primary portfolio gives us lots of optionality, and it gets around what I would say. So one of the issues with co-investing, if not done correctly, is there's quite big adverse selection. So sometimes you get managers who want to do deals that are too big for them, so we get around that by only doing them with the best managers and by being highly selective.
Brilliant, very helpful indeed. And I guess by extension to that, you talked a little bit around ICG PLC and how that, how you link in with the parent company, so to speak. Could you talk a little bit about how that gets reflected in the portfolio, i.e., a couple of deals, perhaps? Talk us through how that relationship works in practice.
Sure. So I might just flick back for a second as a sort of aide memoire to our largest companies. So I think there's two ways that the ICG partnership really adds value to what we do at ICG Enterprise Trust. One is very obvious just from looking at our list of investments. So a number of our largest exposures are to ICG deals. So you can see Minimax, you can see Udo, Visma, Doc Generici, all deals where ICG is a sponsor or a lead part of an investment syndicate. Now that means that the first thing is that ICG's investing style is very similar to ours. And it's interesting that even before we joined ICE, even before the management of the vehicle went to ICG, ICG was actually our longest standing manager, even when we were a third party. So we first invested, Enterprise Trust was formed in 1981. We made our first investment alongside ICG in 1989. So it's a very aligned investment philosophy. So these businesses, so things like Minimax, it provides fire protection, it manufactures fire protection components, and also provides the services to maintain fire protection infrastructure. Now, I don't need to go into that business in too much detail. It's for people to realize it's a very sort of defensive growth type of business. It's got recurring revenues. It's something you have to have. It's driven by regulation. So we get access to these kind of deals by being part of ICG. And not only do we get access, the ability to invest in them, we also obviously get very detailed diligence access as well. So that's a massive advantage. But what you don't necessarily see is the advantage that we get from the institutional knowledge within ICG. So for more or less every investment decision that we make, we're able to sort of tap into the knowledge of the institution, of our colleagues. So a recent example, we co-invested, you'll have seen an RNS announcement, co-invested in a fantastic business in the US called Brooks Automation. Now, we were able to consult with our debt colleagues who knew the business really well, having provided debt to it in the past. So again, it's similar to the example I gave with European Camping Group. We're really able to tap into that knowledge. We're generalists as a team, but we're able to get very specialist guidance and support from colleagues. And ICG is an especially, say, collegiate, collaborative environment. So I think, that gives us a really strong advantage in a PE investing market, having access to that, which I think is pretty unique.
Yeah, couldn't agree more, Colm. That's very helpful indeed. In terms of the portfolio itself, and you touched upon this a little bit, obviously technology has somewhat been in the eye of the storm in public markets. You've talked around defensive growth, but could you just talk a little bit more around well, really, have you got any concerns around your tech exposure at this stage, given all that's going on in publics?
Yeah, so listen, it's a great question, and I touched obviously in my presentation just now about Chewy, and Chewy it's our largest individual investment is PetSmart Chewy. The core PetSmart business is bricks and mortar, so not materially impacted by some of the market movements. But the other part of the business, Chewy, which is both listed and therefore exhibits valuation volatility, and it's an online retailer, so it is more impacted. That's a bit of a unique case because it's sort of specific to that investment, and Chewy was acquired after we made the co-investment. And also, as I pointed out as well, it's still going to be a really strong investment for us. It's just that it exhibits a little bit of volatility. But our other tech investments, the ones that either through our primary portfolio or through a high conviction portfolio, have all been selected because we believe that they're resilient, and we think they will be less impacted when marked to market relative to what most people think of when they think of tech, because they're cash generative and because they're not relying on, as I mentioned in the presentation, on low discount rates, strong future earnings growth. They're profitable today, they're cash generative today, and yet they're still growing really fast. So you can see in the top 10 probably the tech investments to pick out, businesses like IRI, Visma, further down the list, which aren't on this chart, businesses like Reg Ed, AML RightSource. They're tech businesses, but they are not relying on grandiose assumptions about future growth. So we think they're going to be less significantly impacted, and they're continuing to grow as well, critically, because they've all got defensive growth attributes. That means that even if the multiple reduces, they're still going to the growth in EBITDA, the growth in revenue in EBITDA should still mean that we get a really strong investment returns from those high quality assets.
Brilliant. That makes a lot of sense, Colm. Thank you very much. I'll do a couple of questions around the private equity market, and then we'll finish off with one or two around the trust itself and the discount. Although that may well be a board question broadly, but I'm sure we can make some comment around it. But just on the private equity market itself, obviously we've seen an incredible level of fundraising over the past few years, and the large buyout funds seem to get larger. Does this concern you at all? Does this suggest overheating, or is this really just a positive move that more investors are entering the space?
So I think we view the overall growth in the market as being, broadly speaking, a good thing, and particularly as private equity could double, and it's still a relatively small part of the overall equity capitalization, as I showed earlier in the presentation. We look at everything on a case-by-case basis. We've actually experienced over the last decade, as private equity has tripled, we've been along for the ride. We've seen that a lot of our managers that grew fund sizes that at the time seemed like they were expanding pretty aggressively have actually done really well. So managers like CVC and Advent have continued to be successful even as they grew their fund size. And what we think that points to is the strength of those institutions. So as they've grown, they've also grown in their sophistication, the level of operational support they can offer companies, the experience they have in things like capital markets and fundraising. So actually, we've seen a sort of that even as managers have grown, they've not lost some of the magic that allowed them to grow, if that makes any sense. So there are some examples of managers where we view the growth as being excessive. and we've stepped away. We're never afraid to do that. Nobody gets an automatic re-up, and we've actually sometimes decided not to reinvest with managers even when they've done quite well for us, because we feel that structurally we don't think that they're going to be able to continue that into the future. But there's not a sort of automatic rule. So I would say we think that overall the upper mid-market and the larger end of the private equity market actually is pretty attractive. The returns have persisted, and certainly with the sort of core managers we back in that segment, we think that they're sort of structurally very well placed to continue to provide those returns.
Yeah, brilliant. That's incredibly helpful, Colm. Thank you for that. Final couple of questions just around the trust, and obviously applies to the wider sector. Discounts remain fairly prevalent across the board. Two aspects to the question here. One is ICG Enterprise Trust, have you considered, or what are your thoughts around buybacks generally? And then number two, just general thoughts around the discounts that seem to sit across the sector, and whether you've got any comments around that.
Sure, and of course they're interrelated, I suppose. So firstly on the buybacks, obviously it's very much a board competency, but with something we have regular dialogue with our board about, something they're very engaged on. I think the challenge for us is trying to balance, we think that our shares offer very compelling returns at current levels of discounts. But equally, we don't want to we also want to expand our shareholder base. So there's a balance between almost impeding liquidity by being too aggressive with buybacks. But equally, there have been certain periods in the market where we thought that buybacks are the correct option in order to preserve shareholder value. So it's a sort of it's long-winded sort of answer, but it's a constant balancing act. We're constantly reviewing it, but we tend to prefer doing buybacks when there's a structural reason to do so. For example, if there's a large seller or a forced seller in the market, then we might look at doing a buyback. But we would much rather that we were able to, through events like this, promote our cause to a wider group of shareholders, and not get in the way when those shareholders want to purchase large stocks, so large positions. So yeah, not a very committal answer there, Hugo, but that's kind of how we think about it. And you can see that over the last year there were times when we did make some buybacks. Just we saw the discount getting we thought too high. In terms of where it is at the moment, I think it's, I think I would speak for all of my peers in the other listed private equity vehicles, most of whom have persistent discounts, and that we do think that they are slightly anomalous and actually represent, an opportunity for potential shareholders. It's particularly anomalous in the context of what happens when we sell things. So one of the things we always point out is that over the last 5 years, there's been a very persistent pattern of significant uplifts when things are realized. So at the moment, I think our most recently estimated discount from Numis is 27%. Our average uplift when something gets sold is 30% effectively on the NAV, which is discounted by 27%. So we do think that there's an opportunity there. We don't quite understand why the discounts have persisted. And the only thing that we know, sometimes there's a perception in the market that private equity could be quite a volatile asset class, whereas actually we think that the nature of what we do is quite defensive, quite focused on risk-adjusted return. So we view them as anomalous, but obviously this is what the market is pricing it in across the sector.
Yeah, I think that's very helpful, and it does, to your point, it does seem rather anomalous, but not limited to ICG Enterprise Trust. Brilliant, Colm. That has been an incredibly insightful, helpful, and interesting update. Thank you to all the investors that have asked questions, and apologies to those that I haven't been able to get to. There's a couple of you that I will pick up with offline. With that, I think we'll say a final thank you to Colm, and thank you to all for joining, and have a lovely afternoon.
Yeah, thanks very much, everyone. Thanks for your time. And as an Irishman, I'm also going to say happy St. Patrick's Day.
I forgot that. Thank you, Colm. Happy St. Patrick's Day to all. Bye-bye.
Goodbye now.